Huh?
Yeah, that's all. I wasn't planning on moving that money, so.
Oh,
Maybe ever.
okay. Okay, let me know whenever you think.
When it was all the .coms, we were all, when I was working at Maryland, we would
Okay.
pick a couple stocks and be like, we put a couple $100 in.
Yeah.
TWA was my pick. Nobody spoke to me for like 2 months. Every time, how's that TWA? We all got to pick something and we would do that.
Yeah. Oh, that's awesome.
Then we did Apple though.
Before
Okay.
it was like big.
I don't-
$70 a share.
The date, 8/25/2020, retirement board meeting.
That was the pick.
I'll tell you where I screwed up. Was Penn National.
I didn't want to talk too loud because I might find the microphone.
Right? Did you buy those?
I bought it.
Uh-oh,
I bought it at like 16.
really?
I got out at like 35, but where I screwed up, it's like 56 now.
No, I would have taken them out.
All right, I'm here.
Yeah.
I really would have. You know what, you're gonna see that change in the next couple of years.
Yeah. But what really killed me though is I could have gotten it at 4. What are you gonna do?
Well,
I'm over it all.
Could have like $100,000.
Right over.
Everybody ready?
Might as well take the mask off and just defy all the rules.
No. If one of us has it, we all have it, let's be honest.
Honestly, right? Oh, please.
That's on camera too. Anyway, Sarah, you wanna get us, we'll call this,
Yeah.
August 25th meeting of Lawrence County Board of Retirement to order. Chris, please call the roll.
Deputy Controller Prestipine,
Present.
Deputy Treasurer Chalala,
Present.
Commissioner Spillvogel,
Here.
Commissioner Vogler,
Here.
Commissioner Boyd.
Here. I'll ask for any public comment at this time. Silence is deafening.
Okay.
And with that, do we have minutes from this? Do we ever approve minutes from this? Do we have an agenda?
Sometimes Mr. Gettings will bring one.
I'm just gonna take a motion to approve the minutes from the last, if you guys are amenable to that.
I don't want to vote on something I don't have in front of me.
That's fair
Let's
enough.
skip, let's just,
We'll
can we
skip
just
and approve
move
and vote
forward
for
to
the next
it?
one.
Right.
Do we usually have them?
Sometimes we
Okay,
do.
because I honestly do not recall
Yeah, neither do
if
I.
we do.
All right, we'll skip it and move on. Am I missing anything before I turn it over to Sarah?
No, I think you, unless any of the, we usually get, if the board members have any open
Anyone
comments.
have any comments?
No.
I can see we've gotten less and less formal since I took over from Dan. Anyway, Sarah, we'll turn the meeting over to you.
Okay, so, good morning, and I think one of the things that we'll do is, I've given you a couple handouts. We'll talk about those afterwards. We'll talk a little bit about the infrastructure education, so we should probably talk that, we had that education. I did a one-page summary for you, an overview on that, so we'll go through that. Just if anybody asks you of any of the retirees, press, or anybody else wants to know if you choose to go down there. So let's go through what's happened in the second quarter. Let's open up our books. We'll go to, very quickly, Exhibit 1, Tab 1. We talk about, just kind of want to give a quick update on Marquette, even though we are in the middle of this coronavirus. We've actually added a number of clients. We are actually adding a number of employees and hiring. We just hired a new chief investment officer for our OCIO discretionary product, and he will be coming on board. He's from Siegel. He will be coming on board at the end of the month. Just so you know that Catherine, who was our client analyst, is actually going to a high net worth shop. So she will be leaving, so we will be hiring a performance analyst and a new client analyst that will come into the Westchester office, or will work virtually. there. And then I just, wanted to show you community support. These, were just a snapshot of something that everybody who found something near dear to their hearts in this corona epidemic, the firm matched every gift dollar for dollar. So they went out and did that. So may enjoy some of the places they gave to. Maybe some of them you might have, say, well, I'm not sure I agree with that, but it was really what everybody chose to do. So that was
Thank you for
very
doing
nice.
that, yes.
And we've tried to, and I know that we've helped all the local food banks in and around Pennsylvania.
I
So
know you guys helped our United Way,
Yes,
yes,
so thank you for that.
yes,
you're
thank you.
welcome. And we'll continue to do that. We know that a lot of communities are really struggling right now. Speaking engagements, just so I will be speaking at the Controllers Online conference at the end of September. We're looking at, and then I will be doing a pension summit for the Allegheny leading municipalities. So it's just a quick update on Marquette. Now let's turn to the next tab and let's talk a little bit about what's been happening, and we'll talk about what has happened in the second quarter. We know economic activity plunged since the pandemic. If you go look at that chart below, the real GDP growth, they just kind of fell off the second quarter, and we're projecting that hopefully it's going to go up. Third quarter estimates about 5.2. 15.2, sorry, 15.2. Thanks.
Sorry, 15.2.
We're hoping that'll bounce down, so it was really low, and then it'll come back up.
Wait, hang on, 15.2% growth in one quarter,
Yes.
all right?
That is where we're hoping to see, that going. That's what the thing. But remember, you're way at the bottom.
Yeah.
So any growth. Go look at I'll jump very quickly. Go look at page 2. Go look at retail sales.
Right.
They were down 14.7. They rose 17.7. Is that a real snapshot of what's happening with retail sales? Well, yes, it's gone up because everything's
It was so
opened
good.
up again. So really, when you look at those numbers, you have to understand where they're coming from and going forward. We looked at, Powell, the Fed chair, is expected to speak on Thursday and outline the central bank's most active efforts to spur inflation. And they're looking at inflation that they're looking around 2%, which is normally a little bit higher than that. But they are now looking at keeping inflation at a higher standard than they have, higher level, before they do anything since 2009. So we are looking that the Fed's actually comfortable with inflation kind of growing and not putting in any economic measures to kind of take that back. We look at by the quarter end economic data has been extremely strong relative to expectations. If you look at page 2, you can see the unemployment. So we have seen unemployment was at 14.7 in April, and then June was at 11, and right now it's at 10.2%. So the two things that the Fed's got on their minds is unemployment, inflation, and what's going to happen with the markets. And right now the Fed's saying we're not going to do anything. This is a long-term interest rate 0, so we'll talk a little bit about how that seems to affect the fixed income portfolios. We look at what's happened with the coronavirus and how states are reopening. We were actually on the phone with an analyst who came in to talk to us about how the coronavirus is going to affect the market, because that's the biggest thing that we have seen, the swings, the ups and downs. And what they believe is that by January, February of March, you will start seeing a vaccine roll out to healthcare workers. We're probably in the 7th, 8th inning of this. And when you look at the spikes that have been happening with the coronavirus coming back, and there's been spikes in the data, the mortality rate of that has fallen. Hopefully, by next June, we might return to travel and we'll see, us back to normal. It will depend on the virus. The market has really built into that. And when Europe opened up, they had a 20% spike and then they went down. And then they had a little bit of a spike and they went down. So we're going to start seeing spikes, but we do not expect to see that drastic market, fall from that. But you're going to see the market go up and down. We're going to see some volatility in that. If you turn the page, we talk about, outside the US is experiencing a historical contraction. We have definitely seen that in emerging markets. We go look at what's happened. We know that the Fed does not want to see what's happened in Italy. We don't want to become the next Europe with Fed rates going negative. We look at below and you can see, look at the stimulus we did in 2020, and that's through 6/30. Look at that amount of the stimulus compared to where we did it in 08, 09, and 2010. Not to get political, but depending on who gets in as president, it will depend on those stimulus packages. We know that Biden's saying we want another $3 trillion into that. So when we look at fiscal stimulus, it's great for the first 3 to 5 years, but then we know down the road, it's going to have to get paid back. So that's been a concern. And, both parties have really tried to do things to stimulate the economy there. Look at the composite PMI. And this is important because it's a monthly summary report that takes into conditions of private companies. It's manufacturing, service sectors. The composites of the 5 indices include new orders, output, employment, supplies, and delivery time and stock purchases. And why this is important, we look at where China has actually bounced back. We look at the Eurozone and Japan are still struggling. We will see that even though international had a fairly good quarter, we're going to see that those returns are not going to be as high as the domestic equities. And you can just see page 4, you can look, U.S. equities did 22%, international did 16%, U.S. bonds did 2.9, year to date they're at 6.1. That's actually a nice return for U.S. bonds. We will talk about, we actually put you into some high yield. We'll talk a little bit about that, how that diversified the portfolio. And then you can see commodities are down 19.4%, which is year to date, but they bumped up in the second quarter. If you turn the page, we talk about the U.S. equity market and look at the rebound. So the S&P 500 posted its best quarter since 1998. The index finished the quarter up nearly 39% from March 23rd. And yesterday, the index finished up 55% from the March 23rd bottom. So we've really seen this market come back. But then you look at that chart and we talk about the bear market low. And we look at how we react after a bear market. And if you look at 2020, you can see how many days it takes to post bear market returns, a year post bear market returns. So we look at what's happened. Growth stocks have outperformed value stocks again. We take a little bit of a value tilt. They're expecting that maybe some analysts are saying next year that we might see value stocks come back into play. And the one thing is because you're not putting your money into fixed income. The average investor is not getting anything for that. But they also want to be safe. So where do they go to be safe? They go to value stocks. They go to stocks that pay dividends, 2, 3, 4% dividends. And then we also look at stocks. Stocks are a forward-looking asset class. They look at the 12 months going forward, the projections of what's going to happen with their earnings. So looking that way, that's why the stocks are also going up right now, the equity markets, because they're saying that projecting wise, they feel like the earnings are going to come back a little bit on there. And we know that, it fell and the S&P closed up the quarter 20.5%. I do think that it's interesting that there's still $4 trillion on the sidelines in cash as of close of June 30th at that quarter, saying that investors aren't necessarily as sure of the market, so they're putting it still in, but they're still keeping a lot of cash on the books. And we know that that is because of COVID and, where the markets are going to go. We also talked, and I've been saying that we are due for a correction. First quarter is not the correction. First quarter was just mass hysteria, I like to say. So we know that this is going to eventually correct. It can't just keep rising and rising and rising on there. If you turn the page, just want to talk a little bit about where we look at fixed income. You know, fixed income has got a very, it's just not going to do anything. We know the Fed's not going to raise rates. There's no way they're going to do that. We saw housing market has raised housing sales rose to 4.3% in June. We're going to see that. We were talking to our real estate managers, and you know, we've seen a huge issues like in big cities like New York. New York right now has got, you know, there's this outflow of everybody saying, I'm not going to live in New York. I've figured out what it was like during the pandemic. I don't want to be in an apartment. And then we also look at the ultra wealthy with the new tax issues with New York. They're vacating the city. And then you look at how they're going to implement working from home to working back into the city. You know, they're not going to go and say, okay, we're going to still have the same office space, or we're going to get more office space so everybody can do social 6 feet distancing. That's not going to happen. So we are going to see in the larger cities what's going to happen with corporate real estate for the next 2 to 3 years. The housing market is probably going to spike in suburban areas. You're going to see people are going to want to work from home. They're going to want larger houses so they can have an extra room. And money is very, very cheap right now. Are there any questions on the market? Okay, let's turn to Exhibit 3. Let's talk a little bit. Now, interesting enough with the market, what happened was there were 5 stocks in the S&P. So 20% of those stocks drove the market. Or what I'm saying is that those 5 stocks drove 20% of the return. And then 495 stocks, you know, did it okay. So if you would pick those 5 stocks, you know, if we had second quarter, we'd have looked golden. First quarter, you probably wouldn't have asked us to come back. So it really, so when we look at performance, we have to understand that that's one of the things that had happened. The second thing with performance, when we looked at attribution, because we had lagged a little bit, we said, okay, what? One is the value, one is just some of the sector weightings. And that it was a very hard, when the market goes up, it was still very hard for some of those managers just to outperform because it was such a small portion of the market that went up. You still ended the market value for June 30th, 82.2 million. Second quarter, you returned 12.2% with a gain of 8.98 million. For the trailing 3 years, you had an annualized return of 6.2% and a gain of 14.4 million. And since inception, since we became your consultants, you've had an annualized return of 6.7 with a gain of 28.9. The equity composite returned 20% for the quarter. The U.S. equity, 20%. The entire equity composite returned 18.6. Growth stocks continue to outperform, and fixed income returned 3.4% for the quarter, and year-to-date 6.3%. So that's a really nice return. It's one of the larger returns, the higher returns than we've seen for fixed income. And then what we did was we added the high yield manager, Lord Abbett, returned 10% for the quarter. We're going to look at talking about infrastructure. What I want to do is I want to turn and look at the managers and then talk about where we see the portfolio going. So if we turn to page 7 and 8, we'll just see some of the performance there. Again, American Funds Washington Mutual has been a wonderful manager for you. They've done exactly what we want to do. They were 16.6 versus 11.7. They're under the U.S. equity composite. Year to date, they're only down 8.5 versus 15.3. We saw Vanguard Dividend Growth. Obviously, you would say, oh, it's growth. Why isn't it, outperforming? We know long term it will do fine. It's just that that was the S&P 500. You compare it to the S&P 500. Vanguard Dividend Growth is going to hold a majority of all those stocks within that S&P 500. And Eaton Vance has done fairly well for you, and since inception, it's done 10.6 versus 6.5. That's an annualized return. Dodge and Cox did 20.3 versus 12.7 for the quarter. MF low volatility actually did well. It did the minimum volatility index. We added that in there because you could see if you just compare it to the global index, it looks like it's underperformed. But then we really went in and said, let's look at minimum volatility index too, because that's really where it should be. It's just that is what is on your investment policy statement. So we will always put that in there. We look at your non-US equity composite. Hartford Schroders has done very well for the quarter. We put them in 4 years ago in July 16th. And then JP Morgan, we know that real estate, we've talked about real estate. Year to date, they're right on their benchmark, but they're negative 1%. We know that's a very long play. When we talk about infrastructure, we know that we're going to pull some of real estate from there. You did make the decision, we advise you to take not doing the dividends, reinvesting them. Why would you do it at such a high point? Take some of that cash out to help you with your benefit payments. One of the things that we did in fixed income in March is we put in Lord Abbett High Yield Fund. We're allowed to do that within the constraints of your investment policy, but that was a really nice bump. We were looking for any kind of yield that we can get. We have been meeting weekly on this. We're actually watching about twice a week. We slowly dollar cost averaged you into it, meaning that we did 50 basis points, 50 basis points. High yield, the spreads are starting to turn. It's going to hit our constraints, meaning great investment. We're going to probably slowly start getting out of it. It was just something there for the short term, and we'll slowly start getting you out of there, but you're going to take that game. It's really helped. The other thing that really, when we looked at your performance for year to date in the quarter, so at the end of March, market tanks. We had that rebalancing policy that to take you up to target. As you know, I think we sent out a lot of memos back then, and we said, look, take you out to target. The next day, it goes below 2%, they'll buy you back up. That was not going to do this fund any good. So what we said to all of our discretionary clients was that we slowly got you back into the equity market, 50 basis points at a time. So you're a little bit under because you weren't fully invested completely through that whole quarter. But was that the more prudent thing to do? We believe yes. And we will continue to do that. So when you start seeing those ups and downs in the market, we will look at that. When you breach your investment policy, your asset targets, we may feel comfortable enough to go all the way back in, or you may just do it slowly. Let's turn to, or does anybody have any questions? All right, let's turn to these pages. And I just want to show you, this one is your current asset allocation. And you're up to 86.6 million. So that was very nice. That was close of Friday. One of the things below is we're going to see your US equity and your non-US equity. You're about 1.87%. So we're allowed to go to 2%. We'll see what happens. So we may do some trading next week and rebalance that and take a little bit off the table with there, just because we don't want you to breach that. Then we look at the performance update. And this is net. So this is after all the fees are paid. So quarter to date, you're 3.6 versus 3.9, exactly where you want to be, right on that benchmark. And year to date, you're going to see that you're in positive territory there. The global equity composite did 5.5. Your non-US equity did 3.6. And fixed income, yet again, Lord Abbett did 5.1. So that added to 1.7. You have the Fidelity US Bond Index Fund. Probably one of the things that I'd like to do in the next 3 to 6 months is probably restructure a little bit on your fixed income and get some more active fixed income managers in there. And we can do that. We would probably, you did change to the aggregate, which helped you. You may go back to the intermediate government credit. And that is only, you might say, well, why are we switching back and forth? You have to be as active as you possibly can be in fixed income right now and try and get any little bit of return. You're required, I mean, if you can't go, since I want to go 100% equities, you can't do that as a pension fund. You need fixed income. So, when the markets go up, you can take some money to pay your benefits off the table from equities. Fixed income, though, markets go down and they continuously go down for 4 or 5 quarters. We've seen it. We've all been there. You still have your fixed income that's in positive territory that we can take your benefits out. Are there any questions so far? So since you had the education meeting, we had talked about being able to do infrastructure. So I did a 1-page overview. I know that we had gone into that, but I just kind of thought that might be helpful, and anybody asks you questions. We are asking that you would put 5% into infrastructure. There's 2 ways that we're going to do it. So we're going to lower your U.S. equities and your international, and then we're also going to lower your real estate. Because infrastructure takes about 18 months right now, we're probably going to do a listed global infrastructure, which is going to be a mutual fund or a CIT. So we're going to look back at that and maybe try and put you into that until the infrastructure gets called, which would be, we would think JP Morgan. When we know we're closer to you being called, we'll put you on that list. We'll do a real in-depth on JP Morgan. We like JP Morgan. They are very good for the size of your plan there. And you also have them as your real estate composite. And they have done well consistently, and they work with pension funds, which we like. They understand that liability you have. So infrastructure sectors, economic infrastructures, transportation, energy, utility, communications, socials, municipalities, universities, hospitals. So that's where infrastructure goes in and will build. We know it provides diversification for the pension plan, which is important as we look at the markets going forward. Cash flows are not highly correlated to other asset classes, which is important. We probably would not, depending on where you are in your benefit payments. When we've got the actuary in, we look at that in a year or 2, we'll probably maybe reinvest those dividends, or we might actually take those dividends out to help you pay for your monthly benefit payments. It's also a great hedge against inflation. We just talked that, we're seeing inflation, the target's around 2%. Hopefully in a couple of years, we start seeing inflation going up, because that means that the economy is really growing and the consumers starting to go out and spend again, which means consumers employed again. We're going to see a large, depending on how this economy gets back, we're also going to see what happens with, unemployment. And that, we've seen a lot of employers slowly starting to lay off, that middle management, with everybody working from home. That's going to, really drive through downtown Pittsburgh. I just drove through it. It's almost deserted at 3:00 in the afternoon. And, PNC took 1,000 workers, said you're going to permanently work from home. Well, that's all those restaurants, all those service industries around having an active downtown Pittsburgh. So, that's really, and that's just us. Think about, all the other mid-sized cities that are going to be affected by this. So, it is going to change a lot. And we think that it's infrastructure's got some strong performance. We look at it returning 5 to 7% over the course of 10 years. But that's annualized. It's a nice performance there. And it also drives demand despite market downturn. So they're still going to build bridges. They're still going to build hospitals. You're going to see municipalities growing, larger municipalities growing. You're going to see government growing. So infrastructure is always going to be there. It's always, not going to stop repairing roads and everything else like that. So we would suggest doing an open-end fund. That's the only fund we would do, meaning that there's liquidity in there and it's transparent. So that's very important. Are there any questions?
Just if you would, though, getting back to the performance of our specific fund, reiterate how we did in the second quarter, percentage-wise.
I think you did very well in the second quarter percentage-wise. You actually did, I've done so many numbers, I have to go back. He did 12.2%. That's a really nice return, considering that you've got fixed income, you've had some real estate in there, and you made $8.9 million just for that quarter.
And that was April, May, June, if I'm not
Yes,
mistaken.
correct.
And from what you stated, then July and August haven't been all that bad either, have they?
No, July has been, and this is where, quarter to date, so July did 3.6%. You're positive territory at the end of July. You're at 84.9 million, and now you're at 86 million. So I think, with the board that you have done a really good job diversifying, and that this pension fund has really been able to go through one of the most volatile bumps that I have seen in my career it was just mass panic. There was no rhyme or reason to it, in March and April, that was pretty tough. So I think you're in, very good shape.
And are you recommending to the chair that he ask for a motion then for the board to implement your recommendation of investment in infrastructure sectors? Does that require formal action on the part of this board?
Okay.
And so before we call for that motion, we're looking at an increase of 5% in infrastructure.
Right,
Right.
and then actually it's right in front of you.
There we go. So this asset allocation would be for everybody, add 5% to infrastructure target asset allocation guidelines, decreased private real estate from 10% to 7.5%, decreased domestic equity from 48% to 46%, and decreased international equity from 17% to 16.5%. So unless there are any questions for Sarah, I will take a motion on that.
I'll move that the addendum that the chairman just referenced be approved and implemented.
I'll second.
All right, hearing the motion in a second, is there any discussion? Hearing none, Chris, please call the roll.
Deputy Controller Prostaplein,
Yes.
Deputy Treasurer Chalala,
Yes.
Commissioner Spill
Yes.
Commissioner Vogler,
Yes.
Commissioner Boyd.
Yes.
Motion carries.
Thank you. We're moving to infrastructure.
All right, so we will start doing some of those, implementing some of those pieces. Mind you, it's gonna take 18 months, so we're gonna try and figure out what else we're gonna do there. There's two other things I'd like to do is when I come back for, the November meeting, hopefully we're still meeting like this.
Okay.
When we schedule that, I would like to talk about changing the, fixed income. I'll give you some education on that. I would like to see you in a more active fixed income, possibly for the next 12. Probably next 2 to 3 years. I think that's gonna make sense for you. So we'll do a little bit of that. And then the other thing I just want to talk to you about is, we have OCIO. We actually we work with a lot of the operational parts on your pension fund. And one of the things that we always look for is that I know that you've got several firms that come in and do your securities litigation, meaning that if there's a lawsuit, they would come in and do that. I've been working with JPM, which would just do the securities monitoring. It's completely free. So that is one of the things that we would just like to add them in to the portfolio to have an extra set of eyes on that. They also really specialize in pharmaceutical litigation, and this means that if your mutual funds they would be able to catch out if you have a security in there. They monitor that. So that was one thing that we would like to just add them on to the portfolio, just to be able to monitor it for you. It's no charge at all. And then we would just send something over for it to be signed.
Okay. Any other questions from the board related to that?
Not to that, but to one thing that Sarah did reference, the November meeting.
Yes.
And I pulled my calendar up, and I believe traditionally we've met on the third Tuesday of the month.
Right.
And that would be the 17th. And I think we're okay because if I'm not mistaken, the CCAP conference, whether it's live or virtual,
Right.
is probably the 23rd and 24th. So I think at this point, we're okay with the 17th.
And I think the CCAP is actually gonna be canceled.
Hasn't been yet, I'm on
Well,
their
you didn't
board.
have to say that out loud.
It hasn't been yet, but if I were a betting man,
Oh,
I'm just impressed that you have a calendar on your phone.
All right, so we'll do, I know, I hope it's not, because that is my favorite. Nothing except treasurers and controllers conference.
no, in fact, that's the one Loretta and Morgan were able
That's
to
the
go
only
to.
one we got
The
to
only
go
one.
to.
I wasn't
It's
one
like-
even commissioners.
I know.
It is a nice event.
Very nice.
It is very.
Mhm.
I think the board's gonna make a decision within the next week or two.
I was up at Carbon County last week and was talking to Wayne.
How is Wayne?
He's.
What a
he's
gentleman. Does he have 2 new commissioners?
great. He has 2 new commissioners, he has a new controller, and Ronnie, the treasurer, who's been there for years, is not gonna run again, so they're gonna really have some changeover, but actually, they're doing really well, and, but I had to do that meeting with a face mask on, and they were changing custodians, and they really wanted me to say what custodian to go to, and I was like, wink, wink, you guys have to pick it, I mean, it's not my decision ever, we'll work with any.
Right.
But it was interesting doing a meeting with not being able to see everybody's facial expressions.
Is there a meeting room in their original courthouse or is it in the building
It's in the
nearby?
annex.
Okay,
Yes,
that's such a pretty little town, isn't it?
It's
Jim
a
Thorpe is such a
beautiful
neat
town.
little town.
it is. I'm going back there for another meeting, and it's in fall, so I'm hoping.
Oh,
to see some.
Give my best, they call it Little Switzerland. They
It's
call the
just
town Little Switzerland.
beautiful.
It's beautiful. It sits down in a valley. It's a neat little town.
It's an interesting drive in weather, though, I can say that.
If you see Wayne, give him my best. He's a real gentleman.
Yes, I've worked with him, with my old firms, I've worked with him for over 20 years.
Nice man.
Yes. Great County, and you guys are also Great County. I enjoy working with all of you, and I think you're in good shape, and we'll see you November 17th. If there are questions, we will feel free to call me, and then I will keep you posted on how we're doing that trading. So you'll see some memos and stuff coming over in the next couple of weeks with that.
Sounds good.
Okay, we'll have to double check, and I'm sure Vanessa or Chris, I can't remember if we advertised it at the beginning of the year, but if we didn't, we'll have to advertise that retirement board.
Pretty sure it was.
You think it
I'll
was?
double check
Okay.
it, yeah.
Thank you.
Okay. Any further questions? Nope. Any additional public comment?
Don't wish the night.
I'm impressed. Yeah, no, I guess
Okay,
it's
that's it.
it's not interesting. All right, we'll take a motion to adjourn at that point.
So moved.
Second. Motion second, is there any discussion? Hearing none, question on the motion, all in favor, please signify by saying aye.
Aye.
All opposed, the same sign, motion carries. Orange County Board, Retirement Board is adjourned.
And I'll send that 2 PM paperwork over.
Sounds good.
It was great to see everybody.
You as well, yes.
Good to see you, Sarah.
Definitely,
Take care.
always, I know.
How are our friends out in Westchester?
Well,
How's life?
they closed, we were starting to